time for hot picks. Let's look at some Canadian financials, some of them with big market caps. We're joined by Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Great to see you.
Great to see you.
Let's jump right in. You like the look of CIBC these days, Mike?
Yeah, we like CIBC. I think this has been one of the banks that, if you look back at it historically, they had some challenges, and I think the management team has done a really good job turning it around. They've been focused on a few key strategic priorities, including targeting the mass affluent customer in Canada, which tends to be a higher return on equity type business. They've been focused on, growing their private wealth platform, for example. They've been focused on what they call delivering the whole bank to their clients, and that's something that, like, we see as an institutional investor. We see, we participate in a lot of areas of the bank, like equity, capital markets, debt, fixed income, derivatives, and now they're sort of able to deliver that all as a unit instead of different silos. So I think the management's done a really good job, turning around the business, and we started to see that really in the numbers over the past couple of years.
I'm just looking at the stock over the past 5 years. Total return, you've pretty well. Wow, 200% return, whereas the bank's index is only about 134% over 5 years, dragged down by TD and Scotia, I guess.
Right, yeah. Now, despite that, CIBC, believe it or not, still trades at a discount to the group. So if you look at price earnings multiples, it trades at about an 8% discount to the group on average, which we think, given the results we've seen, pretty substantial growth in earnings, pre-tax earnings, across all the business lines. We just think that's not justified in the current environment. We think it should trade at a premium to the group average. Right.
And that's from my Bloomberg data anyway. Yeah. And the stock itself has more than doubled, and you've got the dividends on top. Yeah. Your next idea is Manulife, MFC.
Right. So Manulife is another one where I think the management team has done a really good job transforming the business. One of the challenges as we look back, over the past 15 some odd years with the life insurance sector generally and Manulife in particular, is that these are very long-term contracts that they have, right? And so if you run into issues, like, for example, when interest rates went down, those can take a long time to turn around. But we think management has done a really good job of focusing on higher return businesses. So a couple of key things they've done. They've actually taken lower return businesses, lower return blocks of business, particularly in areas of long-term care and variable annuities, and they've either sold or reinsured those blocks, essentially freeing up about $12 billion of capital that was only earning 5%. Now they're targeting an 18% return on equity over the medium to long term. They're at about 16, which is up 500 basis points over the past 5 or 6 years.
Pretty handsome.
But we think there's more to go. And so where we see them allocating that capital to the Asian insurance businesses that have done quite well, we've seen pretty substantial growth there, as well as the wealth management segment, where we've seen pretty good inflows into that business. And importantly, we've seen improvement in the margins in that business, which is something that investors have been looking for.
And then your final idea for us is Brookfield, so the financial conglomerate.
Right, so Brookfield Corp, top of the house, the mothership, we like to call it, we think is somewhat misunderstood by investors. And again, this is a business where we think management has done a good job sort of trying to realize that value or show the value of the business to investors. So if we look back, they acquired, through the asset management side, they acquired Oaktree in 2019, and then they spun out BAM, Brookfield Asset Management, in 2022. Now, of course, they still own over 70% of BAM. And then they've done a number of other things, including like buying insurance businesses and building that, what they call their wealth solutions segment. And now Brookfield really starts to look more like some of these alternative asset managers in the US, where they've got a $1 trillion asset manager with exposure to private equity, private credit, infrastructure, renewables. They've got an insurance business where they're collecting premiums. They're able to deploy that into the investment management business, earn a spread, and then earn fees on that business. And then they've got all the other operating businesses with it as well, including renewables and infrastructure and so on and so forth.
Right. The stock has stumbled a little lately. Why is that?
It's stumbled a little bit lately. I think to a certain extent, some of the alternative investment managers have had a nice run, and then they've sold off in sympathy with the market. But we still think Brookfield is somewhat misunderstood. It trades at about 12 or 13 times earnings. Some of the alternative managers in the U.S. trade at more like 18 times earnings, sometimes even higher. And so we think there's that valuation gap is too significant, and there's an opportunity to get exposure to that theme, which is something we like over the medium to long term, get exposure to that theme at a discounted valuation.
Yeah, I mean, it hasn't come down that much. I'm showing it down about 8% this year, whereas the TSX Banks Index is down about 3%. So
Right.
it's not drastic. Yeah.
I think that's one of the opportunities